Have you ever noticed how the same old voices keep coming back again and again whenever AMC starts to gain momentum? It's almost like clockwork. The moment retail investors begin to feel optimistic, the short sellers and their media allies appear out of nowhere with recycled claims of bankruptcy, dilution, and doom. But here's the real question. If these people have truly closed their positions and walked away from AMC, why can't they stop talking about it? Why are they still so obsessed with a company that they supposedly want nothing to do with? That's exactly what we're going to unpack today. We'll break down the lies being spread, what's really happening with AMC's max pain zone, and why the actions of short sellers tell us a very different story than the one they want you to believe. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. Let's start with a tweet that made waves recently. Stefan Vikstrom pointed out how the so-called AMC FUD army is louder than ever, spreading the narrative that AMC is headed for bankruptcy. Now, if you've been following this story for a while, you'll recognize the pattern. Every time AMC shows signs of life or when positive earnings reports start surfacing, there's a sudden flood of negativity. Articles, tweets, interviews, and so-called expert predictions. Yet, when you look at the actual fundamentals and retail ownership, the bankruptcy narrative doesn't hold water. It's pure fear-mongering, and the timing of these attacks is too consistent to be random. One of the loudest critics in this wave of negativity is John Hempton, a hedge fund manager who has made no secret of his dislike for AMC. Hempton has been publicly shorting AMC for years and is known for openly discussing tactics like ladder attacks and coordinated short selling strategies. Recently, when asked to give a price target for AMC, Hempton responded that the company should go bankrupt and that he expects shares to fall to $1.50 after more dilution. He framed it as if CEO Adam Aron will endlessly issue shares, multiplying the float to unsustainable levels. Now let's pause here. On the surface, that prediction sounds alarming. But if you really dissect it, the cracks appear quickly. Could AMC issue more shares in the future? Of course, it's a possibility with any public company, but the idea that the float could increase 50 times over is absurd. No serious analyst believes Adam Aron would ever dilute the company to that extreme. What Hempton is really doing here is clever misdirection. By talking about dilution as though it's AMC's fault, he's distracting from the fact that synthetic shares and rehypothecation, illegal short-selling tactics, have already created an artificial float many times larger than the legitimate one. In other words, it's not AMC that inflated the share count, it's the very institutions pointing the finger. What's even more puzzling is Hempton's fixation. He has claimed multiple times that he's covered his AMC short positions, that he's out of the trade, and that he has no interest in AMC anymore. But if that's true, why is he still talking about it? Why is he still posting negative projections and responding to every question about AMC with such intensity? The reality is obvious. He's still trapped. Maybe not in the exact way he admits, but his words and actions scream desperation. If you've really moved on from a trade, you don't obsess over it for years on end. His behavior suggests otherwise. And Hempton isn't alone in this. If you follow the broader pattern, you'll see how short sellers always redirect blame. They claim retail investors don't understand finance. They claim Adam Aron is reckless. They claim AMC is a dying company. Yet what they never address is their own role in creating the mess through naked shorting, borrowing shares that don't exist, and exploiting loopholes in the market. Even when regulators like FINRA get involved, as in the case of the infamous MMTLP freeze, we see the same resistance to transparency. Short sellers don't want audits, they don't want investigations, and they don't want accountability, because all of that would expose the synthetic positions they're buried under. Let's not forget the APE units. 2 years ago, AMC executed a 10-for-1 reverse split and then converted APE preferred units into common shares. On paper, this should have tied up the loose ends. But what actually happened? Billions of borrowed APE shares were never returned. In fact, even after the conversion, trading data suggested that APE shares were still circulating in foreign markets, still being shorted, and still showing up in cost-to-borrow data. How is that possible if they were supposed to disappear? The answer is simple. They were never closed. These phantom positions still exist, and short sellers are stuck holding them with no clean exit. That's why people like Hampton keep pushing narratives. They need retail investors to give up so they can cover those positions at rock-bottom prices. But the retail base isn't falling for it. The same apes that short sellers mock are the very reason AMC hasn't collapsed the way they predicted. The longer these synthetic shares remain unclosed, the more fragile the short seller's position becomes. Now let's talk about AMC's max pain, because this is where the manipulation becomes very clear. Max pain is essentially the price point where the most options expire worthless, minimizing losses for market makers and maximizing pain for retail investors. According to data highlighted by Strom Truther, AMC's max pain recently sat around $2.50, yet the stock closed the week just under $3, specifically at $2.95 after a 4% gain on Friday. This is fascinating because it shows us how hard short sellers are working to keep the stock suppressed just below those key levels. Here's why it matters. In the past, AMC rarely closed above max pain. Short sellers would aggressively push the price down on Fridays to ensure calls expired worthless. But now we're starting to see small but significant breaks. The fact that AMC ended the week so close to $3, even after heavy suppression, indicates the algorithms aren't working as effectively as before. The liquidity that hedge funds once relied on isn't as deep as it used to be. They don't have the same firepower to pin the stock exactly where they want it. Dang. And this shift tells us something important. The tide is turning. Every time AMC flirts with or surpasses max pain, short sellers lose money. It forces them to either hedge, buy back shares, or bleed capital to maintain control. That's why they fight so hard to keep it down, but also why the cracks are starting to show. If the old playbook was still working, we wouldn't even see these moves toward $3 on Fridays. The fact that we are means their grip is weakening. So what can we take away from all of this? It's simple. Short sellers like Hampton may say they're out, but their actions betray them. They're still fixated on AMC because they're still trapped in a position they can't escape without massive losses. They spread fear about dilution and bankruptcy, but those claims don't match the reality of AMC's earnings, retail ownership, or actual share structure. They shift blame onto Adam Aron and retail traders while ignoring the role of synthetic shares and naked shorting. And most importantly, their attempts to control max pain are showing signs of failure, hinting at a loss of control they can't afford. The louder they get, the more desperate they sound. The more desperate they sound, the clearer it becomes that retail investors are making a real impact. And as long as that continues, the story of AMC is far from over. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.